We're going to talk about oil today. There's been a lot of activity in the oil markets. We had negative futures prices, and we've had a lot of news around oil from the demand side, the supply side. But I think for our viewers, what we'd first like to do is sort of take a step back and walk through the oil story from the side of a producer. So maybe take us through how a producer um, looks at the oil market and the oil's futures market.
So say, for example, you're an oil producer and it's mid-March. A lot of crazy things are happening. You have oil coming out of your wells that's going to be ready for delivery in April. So you say, I have no idea what oil prices are going to look like in April. This COVID-19 thing, markets are panicking. So you go out and say, well, what would somebody pay me today to send them a barrel of oil in mid-April? And at that point, it was $23 a barrel. So you say, deal. So I get my $23 a barrel now. All I need to do is deliver this barrel of oil to somebody in mid-April. So from the producer side, it's clean, it's easy, you're done. Then you think, who bought that contract? One situation is that somebody who actually needs the oil. So it's a refiner. Refining activity is down 90% or so that's unlikely. Or it's somebody who doesn't need the barrel. They actually have no intention of ever using the barrel of oil. They're a speculator, they're a hedge fund, they're a commodity trader. And they're just saying, I actually don't want this barrel of oil. I want to buy this contract because I think between now and mid-April, oil prices are going to go up and I can sell it for a higher price later. So those are basically the big players.
Right. And an oil, just for the viewers, an oil contract represents 1,000 barrels of oil. Mm-hmm. So what happens after that part?
So say, for example, you're working at your hedge fund, you have this contract, it's coming due on April 21st. If you don't sell this contract before April 21st, you're getting 1,000 barrels of oil. And you can't just put that in your bathtub. There are laws on how and where that needs to be stored. So, it's April 17th. You're calling around to oil storage facilities. You say, hey, I might have to actually accept delivery of oil. Do you have any room that I could rent? And they say, actually, we're all accounted for. We've already rented out all our space. So you call another place and it's the same deal. So you start panicking. And now say it's April 20th. Contract's going to expire tomorrow. You think, wow, I have to get out of this contract. So you think, all right, I'll sell this for $5. No takers. Okay, I'll give it away for free. I will give you free oil. No takers. And eventually it gets to the point where on April 20th, at the end of the day, that person in that situation was saying, I will literally pay you $37 a barrel just to take this off my hands so I don't have to accept physical delivery because I have nowhere to put it.
Wow. That is something.
Yeah.
That is something. So given that, as we look at the price action relative to the supply and demand side, there's sort of two elements to this. There's the speculators, and we've witnessed some of the speculators having a lot of difficulty. And maybe describe for the viewers what's happened in some of the oil ETFs,
Right.
USO being one of the largest, but here and around the world.
So there are plenty of investment vehicles like ETFs that they're essentially speculators. So they're providing their investors with exposure to oil price movements, and they have no intention of ever actually taking physical delivery of oil. So you can read their prospectus. USO, for example, what they do is they'll buy the next month's futures contract for WTI crude oil, and then they'll sell it a week before expiration, and then buy the next month's futures contract. And they're constantly rolling these contracts. So, they got beaten down pretty bad. Thankfully, they didn't go to zero, because when they sold the contract that expired April 21st, they sold it on April 13th. And they probably got somewhere around $18 for it, which is higher than negative 37. So they were able to roll over. But there were other investment products. There's one in China, for example, where the prospectus basically said they're going to sell the contract the day before expiration and try to roll. So in April, what that meant is they sold their entire portfolio for negative $37 a barrel, which meant you as an investor, not only did your investment go to zero, the bank is actually trying to recover money from the investors. So the bank is saying to the investors, actually, you owe me money because this contract expired negative. So we're seeing that. And then also levered ETFs. If you have 2x exposure, 2 times the exposure to daily price moves, a lot of those they've blown up.
Yeah, they've
They've
wiped out.
gone away.
Yeah,
So
there's some with even 3 times exposure, and those have all been shut down or are being shut down. So there's actually been some class action lawsuits been forming around some of those ETFs already. So it's going to be an area of scrutiny, I'm sure, by the regulators, and it's just a reminder that to watch out for these products that are levered, because you don't always know how they work, and you don't always know how the price action can affect you in any given trading day. So just a word of caution. So let's move on to supply and demand. So COVID-19 has created a tremendous reduction in demand. So maybe walk us through the demand side, and then we'll talk about what's happening on the supply side.
So the shock to demand is virtually unprecedented. It's difficult to estimate how much demand has decreased, but very suddenly, at least 30%. You just use that as sort of a simple number. So down 30%, you think, how does that happen? Well, I mean, there are no planes flying. Very few people are commuting to and from work. So you can see how the demand side declined significantly. Economies are shut down. So then you think on the supply side, well, we just had OPEC cut production, but they only cut production by about 10%. So if your demand falls 30% and your supply has only been cut 10%, you haven't really solved any problem. And the fact of the matter is, whether OPEC was going to agree to cut supply or not, they had to, because if they didn't, there was nowhere to store the oil. So it ultimately didn't really change the situation too much. So on both sides, you have really an unprecedented supply shock that has only gotten slightly better, and an unprecedented demand shock.
Right.
And what that has created now is a storage crisis, because the world is just awash with oil, and we're running out of places to put it.
Right. And as we look at sort of the narrative around oil right now, the sort of the story that is being priced in, at least as far as we can tell, is that we would see a return to normalcy sometime around Q4 of this year. That is what we think is priced in. That's what a lot of analysts are suggesting. However, there's a big unknown around the reflaring of the COVID-19 virus in the fall, which could actually push that demand recovery well into 2021, which we don't think is priced into the market. So maybe give some perspective on that.
Yeah, if you look out at the WTI futures market, you see the October and November expirations are right now trading at somewhere near $30 a barrel, which is approximately where WTI crude oil was before we went into the COVID-19 lockdown. So, that's a somewhat bullish scenario. That's basically saying by then the oil market is going to go back to something near where it was in January and February. So you just outlined sort of the bear case from that starting point. So you think, what could be the bull case? Well, if we continue to have futures contracts expire near zero or even negative, a lot of production has already started to come offline, to be shut in. A lot of producers are having to shut down their wells. If you look at weekly rig counts, the Baker Hughes rig counts, those are falling at the fastest clip since the last time we had an oil price war, 2014 to 2016 time period. So a lot of production is getting shut in. So if you have a lot of producers that have to shut down wells and can't reopen, and then say we get more of a bullish scenario on economies reopening, maybe we don't have a reflare up in the fall, maybe economies do start to open up again in the summer, then that could be a very bullish scenario for oil.
Mm-hmm.
The entire WTI crude oil situation could flip, and you could see prices rise up $50 a barrel or more. So it's just an unprecedented amount of uncertainty right now.
Right. And so let's bring it to the consumer side. We get a lot of questions around, well, what's going to happen to gas prices? I think I see people filling up for well below $2 now. will gas prices go to zero? So describe sort of the process of how the refineries sort of control that and what we think things like gas prices will do.
Yeah, so refiners aren't going to accept oil that there basically isn't demand for. And there is a cost to refining oil, and there are also taxes on gasoline. So you're not going to see gas go to zero. Most likely, you shouldn't go out and buy multiple cars so you have more places to store gas and try to sell it later. You're going to see a lot of the activity upstream from the producers looking at actual prices of crude. You're also going to see a lot of dislocation in the cost for storage. I mean, that's huge business right now. So that's where you're going to see a lot of this.
Right. I think the national average right now is somewhere in the neighborhood of $1.80 a gallon, which I remember when it was $4.20 a gallon not too long ago. So
Yeah.
Thanks, Mike, for filling us in on all the oil happenings. Today also is jobless claims numbers. Can you give us the headline on that number?
Another 4.43 million jobless claims for last week. So
takes our total to what now?
I believe it's right around 24 million now in a little over a month. So the unemployment rate, if it were being struck today, should probably be somewhere around 20%.
So we will take a look at the unemployment rate and the impact it is having on all of us. We're going to be shooting another video doing a deeper dive on that. So stay tuned for that early next week. And thanks so much for joining, and stay safe, and we'll talk soon.
Thank you.